this key market, as you just highlighted, the market legacy theme song remains "Fly Me to the Moon," and potentially back post S&P 500 high altitude rally. Plus 17% if you count it from the November lows post 3-month drawdown. It's the largest rally in 30 years, so certainly exceptional, but now pressured near its all-time high at 48.20, near the 5K roundophobia level. So the key message here is that we are at a behavioral inflection point following the dovish Fed pivot that has been long awaited. And from a tactical perspective, it's the triple whammy confluence of momentum, sentiment, and sector rotation fragility that has remained for most of last year. The market also, from a macro perspective, is likely more dependent on growth numbers, as according to my work, we remain late cycle rather than these excessive valuations, which the market's been banking on year to date.
Yeah, so Ron, so you talked about momentum and sentiment, which remain very, very solid as well. But you erred onto economics at the end rather than technical strategy, and that's why I'm really interested, because the market has been very much focused on the battle against inflation as well. But now we think it's going to be more focused on the battle to maintain growth in 2024. Are you saying that it's the focus perhaps on the latter, which could have a reevaluation of those other two factors, momentum and sentiment?
Yes, and within the approach that we follow at RW Advisory, it's macro, fundamental, and technical. Essentially, all three are realigning for a mean reversion risk. S&P 500 is a case in point from extreme overbought conditions, amplified by record short covering that we saw in and around that area. But also keep in mind that dash for trash year to date from last year, where we had a little bit more small cap, lower quality stocks. So this adds further fragility to what was already a narrow rotation, along with economic sensitive stocks that will likely feel the pressure as the Fed potentially lowers rates, but also particularly if we continue to be in a late cycle stage where growth could disappoint to the downside.
Ron, good morning to you then. You speak about the 10-year yield in the US as well, a surge perhaps remaining ahead. Let's talk a little bit more about that. I mean, stunningly seeing it now below 3.9%, having hit that 5% mark as well in October. More legs, surely not to 5 though, right?
Yes, back to 5 and likely higher over the long term as part of a structural higher for longer trend with rolling waves of volatility. And this is probably what has got the market stumped so far. We've had big swings along the way, but still the trend remains up. The latest correction as a historical analog basically is akin to the October 2022 decline, which then led to the rise up to 5%, that historical threshold. Keep in mind that we're currently at a tactical support level around the 4% to 385 mark. And from those oversold conditions, we should get some tactical consolidation in the short term. So expect rates to not fall any lower than where we are now, inflation to rise perhaps in the second half of this year as part of a long-term secular trend, and watch those key support levels that highlighted on the chart.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.